You were told to save 10% of your income. You were told your home is your biggest asset. You were told to pay off all debt before investing. Almost everything you were taught about money was wrong. Not because someone lied to you on purpose, but because the rules that worked for your parents' generation were built for a world that no longer exists. And in 2026, following outdated financial advice isn't just unhelpful. It's quietly costing you tens of thousands of dollars. Over the next few minutes, I'm going to show you 7 of the most common money beliefs still being passed down today, and exactly why each one is broken. Some of these might make you uncomfortable. A few might make you angry, but all of them will change how you think about your money. Starting today, let's start with the one you've heard the most. Save 10% of your income and you'll be fine. Your grandparents lived by this rule. Your parents probably told you this. Maybe your employer's financial wellness program is still promoting it. Here's the uncomfortable math. If you make $60,000 a year and save 10%, that's $6,000 annually, and you invest that for 35 years at the market's historical 8% return, you'll retire with roughly $1.1 million. Sound decent, right? Except the amount Americans say they need to feel financially secure in 2026 is $2.5 million. And the number they say they need just to retire comfortably? It is $1.26 million. You'd barely make the floor, with zero room for error, health emergencies, or any of the unexpected costs that life guarantees you. The 10% rule was designed when people retired at 65 and died at 70. Life expectancy now pushes well past 80. You could spend 25 years in retirement. 25 years is longer than most people's entire career up to that point. The truth? If you're under 40, the minimum savings target that actually gives you a comfortable retirement is 20%. Closer to 25% or 30% if you're starting late. The 10% rule is a participation trophy. It keeps you in the game but guarantees you won't win. Quick pause. If you're getting value out of this video so far, take 1 second to hit the like and subscribe buttons below. My goal with this channel is to help you build real wealth and avoid the financial traps that keep most people stuck. Let's get back to the video. Let's move to lie number 2. This one is sacred. Homeownership is the American dream. It's what you're supposed to do. And the people telling you this aren't wrong. Owning a home has built more middle-class wealth than almost anything else in American history. But here's where it gets complicated. The average American home has appreciated roughly 4% per year historically. The S&P 500 has returned about 10% annually. That's a massive gap. And it gets wider when you factor in property taxes, maintenance, insurance, HOA fees, and the interest you pay on a 30-year mortgage. A Nobel Prize-winning economist, Robert Shiller, who literally created the index that tracks home prices, found that after adjusting for inflation, homes have returned about 1% annually in real terms over the last century. 1%. Not 4, not 10, 1. Now, and this is critical, it doesn't mean don't buy a house. Homeownership still builds wealth through forced savings and equity. But treating your primary residence as your retirement plan is dangerous. The people who retired comfortably didn't just own a house. They owned a house and invested consistently in the market. The home was one piece, not a whole puzzle. And if you're a renter feeling behind, the 2023 study found that renters who consistently invest the difference between renting and buying costs often out-accumulate homeowners. You're not automatically losing by renting. You're losing if you rent and don't invest. Lie number 3, all debt is bad. Debt has been moralized. In personal finance culture, carrying any debt is treated like a character flaw. Pay everything off. Live debt-free. The gurus make it sound like the goal is zero on everything. But the math doesn't support that philosophy, not universally. Here's a thought experiment. Say you have $20,000 in student loans at 4.5% interest, and you have the cash to pay it off. If you pay it off, you eliminate a 4.5% cost. If you invest that $20,000 in the S&P 500 instead, your historical expected return is 10%. You'd be better off mathematically by carrying that debt and investing the cash. Now the other side is real too. A $7,000 credit card balance at 22% interest, that's destroying you. That is bad debt. There is no investment in the world that reliably beats 22%. Pay that off immediately. That's a guaranteed 22% return on your money. The truth, the rule isn't all debt is bad. The rule is, if the interest rate on your debt is higher than your expected investment return, eliminate it first. If it's lower, carry it and invest the difference. That's how the wealthy use debt, not to buy things they can't afford, but as leverage. Lie number 4. You need to pick the right stocks. Every financial media platform profits when you believe investing is complicated. The more intimidating it seems, the more courses they sell, the more expert advice you'll pay for, the more often you'll check your portfolio. Here's the humbling truth that Wall Street doesn't want you to know. Over any 15-year period in American stock market history, a simple S&P 500 index fund has beaten roughly 92% of actively managed funds, meaning the people whose entire job is picking stocks, professionals with Bloomberg terminals, research teams, and decades of experience, still lose to the boring index fund most of the time. And the average retail investor, someone like you or me trying to pick winning stocks, does even worse. Studies consistently show individual stock pickers underperform by 1.5% to 3% annually. Sound like much until you run it out over 30 years, where it compounds into hundreds of thousands of dollars left on the table. The truth, the most boring investment strategy is also the most profitable for most people. Automate contributions to a low-cost index fund. Never check it obsessively. Let compound interest do what it does. That's it. That's the whole secret. It fits on an index card. Lie number 5. You have time to start later. I want to show you 2 people. They're the same in every way. Same income, same investment returns, same everything. Except when they started. Person A starts investing $500 a month at age 25. At age 65, they have approximately $1.75 million. Person B waits until 35 to start. Same $500 a month, same returns. At 65, they have approximately $795,000. Person A invested $60,000 more in total contributions. Person B ended up with $955,000 less. That one 10-year delay cost nearly $1 million, not from being irresponsible, not from spending recklessly, just from waiting. And here's what makes this worse. 54% of American households have zero dedicated retirement savings. Zero. Not a little. Nothing. And the median retirement savings for people aged 55 to 64, those literally about to retire, is only $87,500. That means they're going into retirement with less money than most people spend in a single year. If you're in your 20s or 30s watching this, you have a weapon that older generations would trade anything for. Time. Every year you delay costs you exponentially, not linearly. The math is that punishing. And if you're in your 40s or 50s, you're not out. But you need to run harder. Maximize catch-up contributions. Cut every unnecessary expense. The truth, the urgency is real and the time for I'll start next year is over. The best time to start was yesterday. The second best time is right now. Lie number 6. A high income means you're wealthy. 67% of Americans are living paycheck to paycheck right now. Before you picture minimum wage workers struggling, stop. This includes people making 6 figures. Lawyers, engineers, tech workers, mid-level managers, all trapped in the exact same cycle. They get paid. Money evaporates into mortgage or rent, car payments, subscriptions, restaurants, kids' activities, and vacations. By the next paycheck, they're at zero. Income is what you earn. Wealth is what you keep. Those are completely different numbers for most people. A doctor making $350,000 a year with a $3 million mortgage, 2 luxury car payments, and private school tuition may have a lower net worth than a school teacher making $65,000. Who bought a modest house at 28, drives a paid-off car, and has been maxing out their Roth IRA for 20 years. The truth, the teacher isn't just lucky. They aren't exceptional. They just never confuse income with wealth. Net worth is the only scorecard that matters. Not salary, not job title, not the car in your driveway. What do you own minus what you owe? That number tells you where you actually stand. Lie number 7. Financial freedom is for rich people. This is the most dangerous lie on this list because it's the one that stops people from even trying. Financial freedom isn't about being rich. It's about having enough passive income or invested assets to cover your expenses so that work becomes a choice, not a requirement. And that threshold is much lower than most people think. If your monthly expenses are $3,500 a month, which is around the average, you need roughly $1.05 million invested to be financially free. That's real. That's achievable. That's not Jeff Bezos money. And here's something even more striking. Financial freedom isn't a single destination. It's a series of thresholds. The first time your investment income covers even one bill That's freedom creeping in. The first time you could theoretically survive a job loss for 6 months on savings alone. That's freedom. Building those thresholds is within reach for the vast majority of people watching this video, if they choose to prioritize it. The truth, the lie that it's only for rich people, keeps working class people from building habits. The data says otherwise. Consistent behavior, compound time, and living below your means. That's the actual formula. 7 lies, 7 reframes, and none of them required you to be a genius or get lucky or inherit anything. The money rules that worked for your parents were built for a world with cheaper housing, stronger pensions, lower healthcare costs, and shorter retirements. That world is gone. And if you keep following the old maps, you'll end up somewhere nobody wants to be, working longer than you planned, retiring with less than you need, and wondering where it all went. The good news is that none of this requires perfection. It doesn't require a high income. It requires clarity. And clarity starts with knowing which rules to break. If one of these 7 hit close to home, drop a comment below. Tell me which lie you believed the longest. I read every comment and I want to know where you stand. Thank you for watching. I will see you in the next one.